What if we told you that the well-known market tracking index fund is fueling a massive stock market bubble? Well, that's exactly what Michael Burry said on Twitter recently. In this video, we will tell you about Michael Burry's warning about the index fund bubble in 2023. Profits in the stock market are not the same as achieving those gains on the exit. If you are also an investor in the stock market, this video will be very important for you. Stay tuned till the end of this video to find out everything. Michael Burry began warning of a stock market bubble in passive investing. In 2022, the SPY ETF and low-cost S&P 500 index mutual funds will be the primary areas of passive investing. According to Bloomberg, passive funds now hold approximately 21.2% of all S&P 500 company shares, compared to only 3.3% in 2003. This generation has grown accustomed to dollar-cost averaging into the stock market, with the expectation that it will always rise in value over time. Over its history, the S&P 500 has averaged about 12% annual returns with 50% drawdowns. Even Warren Buffett believes that buying and holding the S&P 500 is the best strategy for most passive investors. The long S&P 500 investment may have become crowded at this point, and it will require ongoing buying power to maintain current price levels. Profits in the stock market are not the same as getting those gains on the exit. The bulls of the early 2000s learned the hard way. Burry points out that the stock market experienced an e-commerce and tech bubble in 2000, while we are currently experiencing a passive investing bubble in 2022. The majority has grown too accustomed to dollar-cost averaging capital into index funds and purchasing at any valuation or price. Buying at every price drop has also resulted in new all-time highs since 2009. Investors may take profits as people begin to retire and sell their investments, or the stock market may fall as fund flows slow. In a short term, this market exhibits all of the characteristics of an index bubble. Easy monetary policy was also a major driver of the recent stock market bubble, and that dynamic will not be reversed until inflation is under control. Michael Burry believes that index fund investing is destroying the proper functioning of a market based on valuations, earnings, and future cash flow. Fundamentals are no longer used to price in true value. It is another indication of a bubble. Michael Burry says that passive investing has eliminated price discovery in equity markets. According to him, the models that lead people to sectors, factors, indexes, or EFTs, and mutual funds that simulate those strategies do not necessitate the security-level analysis required for true price discovery. Burry believes that the next bull market will be more focused on value stocks. He believes that the discipline of paying for real fundamental value returning to the stock market will make sense. 21.2% of investors who own shares in specific S&P 500 companies do so not because they think it's a good investment, but because it's in the index they buy and hold regularly. A bubble occurs when the price begins to rise independently of any fundamental intrinsic value. The index fund bubble. Experts are raising concerns about passive investing in index funds one after the other. They claim it is an index fund bubble that will eventually burst. Passive index fund investing is a brilliant invention that diversifies investment across multiple assets. For decades, passive investing has proven to be extremely effective. It aided many people in becoming financially independent by simply investing in passive index funds. However, it's curious as to why some experts believe that the index fund is in a bubble. The index inclusion effect. The index inclusion effect states that when a stock is added to a popular index, such as the S&P 500, the value of the asset, that is, the stock price, tends to skyrocket. When investors continue to buy the index, the stock in the index gains undeserved value, even if its fundamentals are not so good. As a result, stocks within the index are overvalued, while stocks outside the index do not receive the attention they deserve, even if their fundamentals are strong. Michael Burry simply states that this creates inefficiency in the market, which he intends to profit from. Less price discovery. Burry also claims that the market has less price discovery. The term price discovery refers to the price at which two parties agree to make a deal. To illustrate the price discovery process, suppose a seller wants to sell a mover for £150. The buyer assesses the value of the mover based on factors such as power and efficiency. Based on his assessment, he does not believe the value is £150. As a result, the buyer counters with £100, and the sellers agree to a deal. This is known as price discovery. In active investing, investors research a company's fundamentals, such as cash flow, profits, and assets, to determine a stock price. Passive investors, on the other hand, are unconcerned about the fundamentals and price of the stocks. It means they assume the stock's value is correct or simply ignore its price because it is included in the index. According to Michael Burry, the large inflow of capital into index funds affects price discovery, and thus the stocks in the index are now overvalued. But this cannot continue indefinitely. According to Michael Burry, the longer it goes on, the worse the crash will be. Argument against less price discovery. To understand whether index funds may influence stock prices and price discovery, you have to first understand how prices for stocks in an index are set. The trading of stocks determines the price of stocks. The current price of the stock is calculated by adding all of these trades together. If index funds are the only ones trading those stocks, then the impact on price discovery arguments would be valid. The Vanguard study, on the other hand, refutes the price discovery argument. What is Michael Burry predicting? The S&P 500 index bubble could burst if all investors began to exit due to a loss of faith in the system. The index can also stop rising or crashing if people stop contributing consistently to stabilize prices. The price-to-earnings ratio may appear lower in bear markets, but the market is pricing in lower earnings in the coming months and years. With other types of investors and traders owning 78.8% of the S&P 500 companies, the index could fall significantly. Stock prices are determined by supply and demand, not theories and strategies. The volume of buying and selling at various levels will drive price action even in the S&P 500 index. Selling and buying the S&P 500 index has an impact on the individual stock prices of the index's constituent companies. They will rise and fall in tandem, with a strong correlation to the movement of the index. A large portion of trading in S&P 500 companies now occurs indirectly via S&P 500 index ETFs and mutual funds. SPY is a secondary market for the shares of these companies. The SPY exchange-traded fund holds the shares, and the SPY ticker is based on these holdings. This removes a significant portion of the company's shares from direct trading on the stock exchange. Vanguard claims that 94% of SPY trading generates no activity on the underlying shares it holds. What does Michael Burry say about the economy? Michael Burry predicted a recession in June 2022, and he has been proven correct thus far. During recessions, stock markets tend to crash as consumer spending falls, economic growth slows, and the economy begins to contract. Recessions are a part of the business cycle that is primarily caused by a monetary policy having to raise interest rates to cool an overheated economy. Before the Federal Reserve starts raising interest rates, bubbles usually form, and inflation takes hold. When financial bubbles burst, they can cause crashes and the unwinding of asset classes, such as equities or real estate, resulting in a flood of supply on the market and lowering prices. While unemployment is one indicator used to determine whether or not a recession has begun, employment tends to peak later after the economic downturn has begun. As a lagging indicator, jobless claims and high unemployment tend to persist well into an economic recovery, rather than a quick reversal in improvement in conditions. The end of the recession marks the bottom of the economic decline and the start of an economic rebound. After a recessionary cycle, it takes time for growth to resume. Why did Michael Burry sell all of his stocks? Michael Burry has exited all of his positions, which had a total value of plus $200 million as of March 31, 2022. As of the end of the second quarter of 2022, the only stock he owned was GEO Group, a private jail operator. As he shifted his capital to all cash, this position reduced his portfolio exposure to only $3.3 million. He predicts a massive economic downturn and market crash in the coming year, bringing stocks back down to their true intrinsic values. He is not optimistic about the stock market or its current valuation levels. That's all for today's video. Do let us know if you agree with the opinion of Michael Burry in the comments section. Stay tuned until our next video. Goodbye.